Stocks. I'm your host, Victor Dongo. Today we shall be discussing more on how to value stocks very quickly. Remember the last time we did our discounted cash flow method, whereby we took the risk-free rate and then used it to discount our cash flows from like the owner's earnings from the future of the business to estimate what it will be worth today's money so that we can make our investment decision. Um, when we were doing that, we did lots of calculation in terms of outlaying each and every cash flow for the each year into the future before bringing it back. To cut that short, I have developed a very quick method. This is my specific method, which I use to quickly estimate what it would be. Oftentimes, it falls around the value of this very detailed calculation. But what this does is it saves you that plenty of time to sieve out which investments you would be focusing on and what not to focus. To do that, we need to quickly understand that we are looking for wonderful companies, great companies to invest in. So it is key that this is applied to great companies. If you apply this to companies that are struggling or that are not performing, you will not have very good results. And of course, the stock price of a business does well if the business really does well as well, except in cases where there is a high level of speculation. That is when you begin to see that the price of a stock goes way too high, even when the business is not doing that well. You need to be able to understand what the company's rates of return is, what the net income or the owner's earning is, the growth in revenue, the growth in net income, who the customers are, where the sources, the various streams of income are coming from, the competitive advantages, and all of that would help you to estimate what the future earning or what the future owner's earning will be. So that itself will help you make the right choice of the stock or the business to invest in. Moving on to the very quick method of doing all of these, it's key for me to point out these things which I'm going to list right here. So this is where we're going to focus our attention on. These things you see on the board would form the foundation of our going for very good stocks and helping us in valuing as well. Okay, so in accounting, when you have plus or minus 5% change in value, it can be said to be negligible. So let me give you an instance. If a company makes $100 million this year and next year it makes $101 million, what it is trying to say is that nothing has really changed. So it's still about the same level. So it means that if a company then goes on to make the following year $107 million, then you can begin to raise an eyebrow and say, yes, maybe this company is still pushing. Yes, of course. This is not a hard and fast rule, but it's just a guide to understanding how the company is performing, whether it's just a flying level or it's going right up or it's going right down. So that is that. Next, a company's natural revenue growth occurs through one, population growth of roughly 2.5%. So what he's trying to say is that the new customers coming on to buy the company's product will come at an increased natural rate of 2.5% approximately. So it means that at the end of the day, if these are the customers you are not pushing to find, these are the customers who, because of age, becomes aware of your product, and then natural increase in population, they get in. These are the ones we are talking about. Moving on from there, you have increase in revenue due to inflationary price increases of 2%. It's trying to tell you that most corporations will have a natural growth in revenue of roughly 5% because of one, normal increase in population, and two, the inflationary pressures on the goods sold. This would help you form a guide. For instance, if you combine these two together, if you multiply this by that, you have 2.5 times 2, which will give you roughly 5%. So it all goes back to that saying that, look, if a company's revenue is just going about by 5%, it means it's practically going on a straight line. So that company would only increase its earning per share if they go to the market to buy back the company's shares to decrease the number of outstanding. That is what this is trying to say. So thank you and have a lovely day. Bye.